Welcome to Autofin Path, your trusted daily source for financial insights, market trends, and economic analysis. Today, we're diving deep into one of the most important questions shaping global markets. Is the United States heading toward a recession in 2025? After years of post-pandemic recovery, a booming stock market, and one of the most aggressive Federal Reserve tightening cycles in decades, the U.S. economy is showing both resiliency and risk. We're seeing strong consumer spending and near-record employment, yet also rising credit card delinquencies, a weakening manufacturing sector, and a Federal Reserve that's starting to cut rates again. So the real question is, are we about to witness another economic slowdown? Or will the U.S. achieve the soft landing everyone's been hoping for? Let's break it down. From growth data and inflation to the Fed's latest moves and what investors should prepare for in the months ahead. To understand where we're headed, we have to first look at where we are. The U.S. economy in 2025 is a fascinating mix of strength and vulnerability. On paper, the numbers still look solid. The unemployment rate remains close to 3.8%, which is historically low. Consumer spending, which makes up about 70% of U.S. GDP, has held surprisingly strong. Retail sales, travel bookings, and even restaurant spending have all outperformed expectations. But beneath that surface, there's growing strain. Household savings, once at record highs during the pandemic, are now at their lowest point since 2008. Credit card debt has surpassed $1.3 trillion, and interest payments are climbing fast as rates remain high. Meanwhile, GDP growth for the last quarter came in at just 1.2%, down sharply from over 3% in mid-2024. Manufacturing output has declined for 6 straight months, and business investment is cooling. These are early warning signs, the kind that often precede a downturn. Economists call this a late-cycle economy, where growth slows, debt piles up, and consumers start feeling the pinch. So even though the economy isn't in a recession yet, the underlying trends suggest we're walking a fine line. Let's talk about the Federal Reserve because its policies will likely decide whether the U.S. economy slows down gently or crashes hard. In September 2025, the Fed made its first rate cut in nearly a year, trimming interest rates by 0.25%. The official reason: to support continued expansion and prevent disinflation from turning into deflation. But if you read between the lines, it's clear. The Fed is getting nervous. Historically, when the Fed starts cutting rates, it's often a sign the economy is weakening. Just look back. Rate cuts in 2001, 2007, and 2019 all came just before recessions or major slowdowns. Now, the Fed is in a tough spot. Inflation has fallen from its 9% peak in 2022 down to about 2.8%, close to the Fed's target, but not low enough to be comfortable. At the same time, the job market is starting to cool, and business confidence is slipping. If the Fed cuts too slowly, growth could stall. If it cuts too fast, inflation could bounce back. This balancing act is what economists call the narrow landing strip, and right now, the Fed's plane is shaking in turbulence. Market expectations now suggest at least 2 more cuts before mid-2026. But as history shows, rate cuts can be a double-edged sword. They boost confidence in the short term, but often signal trouble ahead. Now, Let's talk about the real engine of the economy, the American consumer. For the past few years, consumers have been the heroes keeping growth alive, spending on goods, travel, housing, and experiences. But cracks are showing. A recent Bank of America report found that low and middle income households have nearly exhausted their excess savings. Credit card delinquencies are up 50% year over year, and auto loan defaults have hit their highest level since 2010. Even as inflation cools, the cost of living remains painfully high. Rent prices have risen over